Welcome back to our channel, where we discuss personal finance and investment strategies to help you build wealth. Today, we have an exciting topic to cover: realistic millionaire investing advice in your 20s. Many people believe that becoming a millionaire is only possible for the lucky few, but with smart financial decisions and early investments, it can be a realistic goal. So, let's dive in. 1. Importance of starting early. A crucial piece of financial advice for individuals in their 20s is to initiate investments as early as feasible. The power of compound interest is paramount in the growth of your investment portfolio. By commencing your investment journey early, you provide your investments with a longer runway to compound and expand. This means that even small initial investments can burgeon into substantial wealth over time. Harnessing the advantage of time is a key strategy for building financial security and achieving long-term wealth goals. 2. Setting financial goals. Additionally, it's paramount to establish well-defined financial objectives. Whether you're aiming to secure your retirement, purchase a home, or launch your own business, having precise goals is instrumental in maintaining focus and motivation. Delve into a comprehensive assessment of your financial standing and formulate a clear roadmap outlining the steps needed to reach your objectives. Setting measurable targets not only provides direction, but also enables you to track your progress and make informed financial decisions aligned with your aspirations. This strategic approach is essential for achieving your long-term financial aspirations. 3. Paying off high-interest debt. Before delving into investment endeavors, it's imperative to address and eliminate high-interest debt, like credit card balances or student loans. High-interest debt can erode your capacity to build wealth, making it a top priority to rid yourself of these financial burdens as swiftly as possible. Redirecting funds that would have gone towards interest payments back into your financial portfolio can significantly accelerate your wealth-building journey. Achieving debt freedom sets a strong foundation for more effective and fruitful wealth accumulation and investment strategies. 4. Emergency fund. Furthermore, constructing an emergency fund is an indispensable component of financial security. The objective is to accumulate a reserve equivalent to at least 3 to 6 months' worth of living expenses, securely stashed in a separate account. This financial cushion acts as a safety net during unforeseen situations, preventing the necessity of tapping into your investments or acquiring high-interest debt to handle emergencies. An emergency fund ensures that you can navigate unexpected financial setbacks with confidence and without jeopardizing your long-term financial goals. It's a cornerstone of financial stability and peace of mind. 5. Diversification. In the realm of investing, diversification emerges as a fundamental principle. It's unwise to concentrate all your investments in one place. Instead, distribute your resources across various asset classes like stocks, bonds, and real estate. This strategy is instrumental in risk management as it diminishes the impact of a poor-performing asset on your overall portfolio. By diversifying, you not only safeguard your investments against the volatility of individual markets, but also enhance the potential for sustained growth over the long term. Diversification is a crucial tactic for balancing risk and return in your investment journey. 6. Take advantage of employer-sponsored retirement plans. When your employer extends a retirement plan, such as a 401(k), seize the opportunity without hesitation. Aim to contribute as much as possible, particularly if your employer provides matching contributions. This is akin to free money, an invaluable asset in advancing your wealth-building endeavors. Employer matches instantly enhance your retirement savings, amplifying your financial growth. By maximizing these contributions, you not only secure your financial future, but also harness the full potential of compounding, making it a potent and efficient avenue for building wealth. 7. Invest in low-cost index funds. Novice investors often find low-cost index funds to be an ideal choice. These funds mirror the performance of a specific market index, like the S&P 500, providing a diversified exposure to the broader market. Notably, they come with lower expenses compared to actively managed funds, which can erode returns over time. Historically, low-cost index funds have demonstrated consistent, solid returns over the long term, making them a wise option for those starting their investment journey. They offer a straightforward and cost-effective means to participate in the growth of the market while minimizing fees. 8. Stay consistent and avoid emotional investing. In the realm of investing, consistency stands as a linchpin of success. Cultivate a disciplined approach and steadfastly adhere to your investment strategy, irrespective of market vicissitudes. It's imperative to resist making emotional decisions triggered by short-term market fluctuations. Investing is inherently a long-term endeavor, and steadfast adherence to your plan is more likely to yield positive results over time. Consistency helps you ride out market volatility, harness the power of compounding, and stay focused on your ultimate financial objectives, making it a cornerstone of a prosperous investment journey. 9. Continual education. Continual self-education in the realms of personal finance and investment strategies is paramount. Dive into books, engage with reputable financial blogs, and remain abreast of evolving market trends. The more you empower yourself with knowledge, the more adept you become at making informed investment choices. A well-informed investor can navigate complex financial landscapes with confidence, seize opportunities, and adapt to changing market conditions. Education is your most potent tool for optimizing financial growth and securing your long-term financial well-being. Stay curious and committed to learning, as it's an enduring asset in your financial journey. 10. Seek professional advice if needed. If you ever find yourself feeling overwhelmed or uncertain about investing, it's perfectly reasonable to seek professional advice. A skilled financial advisor can offer personalized guidance, tailoring their recommendations to your unique financial circumstances and objectives. They play a crucial role in helping you construct a comprehensive investment strategy and, importantly, in keeping you on course. With their expertise, you can navigate the intricacies of the financial world more effectively, ensuring that your investment decisions align with your goals and promoting greater financial security. Don't hesitate to reach out to a financial advisor when needed. And there you have it, realistic millionaire investing advice for individuals in their 20s. By starting early, setting clear goals, diversifying your investments, and staying disciplined, you can grow your wealth significantly over time. Remember, becoming a millionaire is not an overnight accomplishment, but with perseverance and smart financial choices, it's a realistic goal. Thanks for watching, and don't forget to like, comment, and subscribe for more insightful content on personal finance. Until next time.